It's a great day in 1792. 24 gentlemen put on their finest short pants and top hats and got together under a buttonwood tree on Wall Street in New York City. 200 years later, now it's the place where the world's largest stock exchange, the New York Stock Exchange, is located. Capital market have played a significant role in the modern world since decades after World War II. It built the American middle class, and for people who knew how to play it right, trading their stocks properly could build a fortune. Like this guy.
I've been working on the railroad all day.
But what the heck is capital markets all about? What is the whole hype about Wall Street, stocks, bonds, inflation, and all that mind-boggling jargons? New thinking, new finance. Welcome to the session on Introduction to Capital Markets, brought to you by Legend Finance Academy. Capital markets are markets where money is exchanged between people who have access of it to those who are in need. Now when we say access, he may not be a snobbish guy with a fleet of super luxury cars and a lot of cash. It could be anyone having a regular lifestyle, with some money for which he has no immediate use. Similarly, someone who is in need may not be a beggar on the road. They are companies or organizations who are already doing well in their business, but require more money to expand operations. For instance, Jill, an industrialist who produces cardboard boxes. Jill manages to clinch a deal with Amazon to export packaging boxes to their logistic unit. However, his company, Jill Paper Incorporated, is currently functioning at full capacity and has no room for new orders. If Jill Paper Incorporated takes up this contract, then he will have to set up another industrial unit which would cost $1 million. Jill can go to the bank to borrow money, but the bank will charge a high interest rate. Chances are, even if Jill can afford the interest rates, banks will and ask him hundreds of questions, just like your parents do before lending you money.
How much you need?
There is another option. Jill can make his company go public and get listed on the stock markets. This means that he's reaching out to the public for investments in his company in exchange for part ownership of the company. Public here means the common people would invest in Jill as they believe in his business. This is called IPO. Here's another common question: what is a share? Let me start by explaining that shares, scripts, equity and stocks are jargons that actually mean the same thing. So next time you hear someone saying any of the above, you know they are referring to the same exact thing. Jill, again, and 4 of his friends are going out for lunch and decide to order a pizza of 10 slices. That will cost them $10. How much is each of them supposed to pay for their share of 2 slices? $1, $2? Simple mathematics. But here comes the problem. Jill wants to eat some more. He is willing to pay a premium of 20% and buy another slice at $1.20. His friend, Sam, agrees to stay hungry and instead earn the profit from the sale. Now this makes Jill the majority holder for the pizza, so he can decide the toppings for the pizza. He likes veggie, so that's what it's gonna be. But 3 others dislike veggie and decide to gang up against the decision. Together they are 60% of the shareholders, and so the group, as a whole, has more control on decision taking. And now it's going to be barbecue chicken, just like the 3 friends wanted. Jill is pissed off and is compelled to agree. Replicate the example in the real market, and you understand that buying a share of a company is like buying a slice of an enormous pizza. Jill and his friends would pay for a pizza because they can't make it. But what about potatoes or any other vegetables? We all know that planting a seed is not that difficult. Then why we go to a vendor to buy vegetables? Why should we pay for something we can do ourselves? The best answer to this is opportunity cost. Simply put, come on, you've got better things to do than grow potatoes. All due respect to farmers. You guys are doing a great job. After all, without you we wouldn't be able to have the amazing pizza. This means that we are willing to pay a certain cost for buying products or services instead of making them ourselves. Similarly, the capital markets allow investors to invest in companies they believe in, rather than starting similar businesses. But why would people believe in a company give out their money? It was a beautiful night. Jill, lying in his couch, was watching a documentary on rising oil prices. Suddenly, he realized that someday, oil may get so expensive that common people may find it impossible to consume it on a regular basis. The future is going to be about renewable energy like solar, wind, or tidal energy. Amongst all these, Jill believes that wind energy may be the next big thing. Is he expected to quit his current job and start setting up windmills all around the world? Forget that. He wants to be part of the booming industry, but does not want to physically be involved in the operations. Capital markets allow him to do that by investing in shares of Vestas, one of the world's largest wind power companies. At the current market price, as of the 24th of June 2021, it is trading at $12.17 on the Nasdaq, almost as cheap as a pizza. This is also known as value investing, which deals with looking for the value that an organization is creating. Warren Buffett believed that, if he liked drinking Coca-Cola, and his friends liked it too, there was a good possibility that many others would like the product, which would finally lead to the growth of the company. Since he bought in Coca-Cola at $2.40 per share 33 years ago, the stock has been rising up over 2,000%. But this guy hates it. Only if Jill navigates it right, he's gonna be driving a Ferrari and living in a beachfront mansion in the coming decades. Shareholders want to make money, so if the CEO makes a really bad decision, they'll start selling their shares, which will drive the price down. The opposite is also true. The possibility of a future payout encourages people to invest in risky new ideas.
You own the company. That's right. You, the stockholder. Well, in my book, you either do it right or you get eliminated.
That's the whole idea of the stock market as a force for good. It drives companies to make good decisions, so they have more money to give back to shareholders and more money to grow and create jobs. It provides money for the government to help it pay for new roads, schools and hospitals, and they can help lower the costs you face buying food at the supermarket, taking out a mortgage or saving for your retirement. That's good for everybody. That's how capital market works. It may seem confusing, but essentially, it exists to bring people together, so money flows to where it is needed the most. That's all for today's video. What's your thoughts about this topic? Or do you have any good or bad experience in the market? Share with us down below. If you found this video interesting, consider getting subscribed. Thank you very much for watching, and I hope to see you in the next video.